Good afternoon, everyone, and welcome to the CME Group's webinar on grain futures. Today, we'll be focusing on a short analysis on how to quantify fundamental data. My name is Anthony Cohen, and I'm the Head of Application Specialist for the Asia-Pacific region at CQG. The U.S. Department of Agriculture, also known as USDA, releases various data sets related to the production, stocks, and use of soybean, wheat, corn, and many more agricultural products. The production and therefore prices are easily affected by certain factors like the percentage of area planted, the weather, and the conditions of the crops, and so on. Out of all these data, we'll pick a couple of examples. We will start by looking at the crop progress conditions data. The USDA provides conditions values for each of the producing states in the US in percent terms. On top of that, the USDA provide the same figures for the 18 states that planted 96% of the 2020 acreage for soybeans and 92% for corn. In other words, rather than having to look at each state individually, we'll be able to get a more general picture of the status of the conditions in the US. This is the conditions data for the 18 states for corn applied to a weekly chart, as can be seen below the chart. The data is broken down into very poor, poor, fair, good, and excellent conditions, and shown here as accumulated values. The aim here is to try to measure the impact of certain conditions on price. This is, of course, not as simple as it sounds, as there are situations where multiple factors will influence the price concurrently. Without trying to sound pessimistic, we'll only focus on the negative aspect of that data, which is poor and very poor conditions. Also, to be sure that we do not fall into the forward-looking area, we're making sure that we're using the data after the day of the release, since the data comes out end of the afternoon US time. The next task is to identify the degree to which very poor and poor crop conditions affect prices. We can see that historically, there's been an acceptable level of poorness that the market is willing to work with. We can take two measurements. First, we look at the range of a bar when the percentage of crop considered very poor is above 5%. Then we look at the range of a bar when the percentage of crop considered poor cumulated with the very poor is above 15%. The assumption here is that the market will be bullish due to potential shortage, and we want to have an idea on how bullish the move will be price-wise. The pink histogram below the chart shows the average range of the bars when the poor and very poor conditions occur. This is expressed in number of ticks, which is the smallest price increment for this contract. With this information, we can plot the projected highs and see a quick representation of the evolution over a few years, since we're actually working with limited seasonal data. Our projected high for the very poor and poor condition situations are represented in dark red, like here, and red, like here on our chart. So the data in 2006 shows rather erratic data points, which is normal due to the fact that there isn't a lot of data taken into account in the averaging calculation at this stage. In 2007, we can see a slight improvement, and the projected highs are getting closer to the actual highs. By 2011, we can see that we get a lot more accurate points for both the very poor and poor conditions, and that the data points are starting to fit the highs more accurately. So we get a better picture on how the move is expected to be when those conditions occur. We can go a little bit further when it comes to conditions data. Although the USDA provides very comprehensive information, we can source some data elsewhere. For example, we have the drought monitoring website, drought.gov, which offers historical data by state or by group of states. This data is not directly available in CQG, but we can first download it into Microsoft Excel. And then from Excel, we can import the data into CQG for further analysis. So we can see that all of the historical data, column by column, is then represented below a chart. Fortunately, crop conditions aren't bad all the time. This means that price moves can also come from other factors such as supply and use. Realistically, we can only assume that this would be the case outside of the times when the crop reports are published. In other words, if two factors occur at the same time, it's a lot more difficult to establish which one is responsible for the market move. But if we have opposite pressure points, like bad crop and low demand, it's difficult to see which one actually influences the traders more. Similar to what we did just now with the crop conditions on corn, we can use the supply and use data to create data points and hopefully show the expected price move on certain days. With the difference that we will have more regular data points to work with, as the data release is no longer seasonal like the crop conditions. This also means that the fitting will be more accurate as we go along. The easiest way to quantify the moves generated by the fundamental data release is to average out the upward moves created by lower supply yield data and apply that value to the days open. The upward move here is calculated as the difference between the daily high and the daily open. Once again, we use the opening price to apply our calculation simply because the open is very representative of the day's mentality and also because it's the most static price of the day. That price, once it's established, doesn't change anymore. The markets being mainly more aggressive on negative news than positive news, we're purposely keeping the upward and downward move measures separate and will therefore do a similar calculation for the downside. However, our calculation for the downward move will use the difference between the daily open and the daily low on the day of the release. We'll then apply the average downward move to the daily open of the day of the release. By doing so, we'll be able to project the expected upside or downside level on our daily bars. We can see the values for both the change in supply below the chart over here, as well as the percent move on that day over here. Once we have applied the average values represented here as the green dot, like here, and the red dot, we can see that the projected values are a relatively good fit. We could theoretically take it a step further and calculate the average move of a 1% change in supply data. But the data of a later time period shows that it might not actually make it more interesting. There are occasions, like this one, where a small change in the data release actually creates a much more erratic move on the price than expected. So in other words, we're probably just as good using average data like we've just done so. This concludes this presentation, and I'd like to thank you all for your time today, and don't hesitate to send us any questions if you have any interest in CQG. Thank you.